So you want to own a gym, $10 a month, maybe 15. The cheapest, simplest business idea most people can imagine: rent a box, fill it with treadmills, collect the dues. So why are actual Wall Street banks structuring billion-dollar bond deals around companies that charge that little? And why is a diabetes injection, of all things, quietly becoming one of the biggest forces reshaping who walks through the door? Buy the building, sign up members, watch the money roll in, except that's almost never how it goes, so you still want one. Let's find out what you're actually buying. Here's the one-sentence foundation. And if you already know it, stay with me anyway, because what comes after it is the part almost nobody covers. A gym isn't really a fitness business. It's a subscription business that happens to have dumbbells in it. Most members pay every month and rarely show up. And that's not a failure of the model, it's the entire model. A building sized for the fraction of members who actually use it, funded by dues from the much larger fraction who don't, is exactly how the math is supposed to work. That's true whether you're running a 5,000-member budget chain location or a 200-member boutique studio. The ratio changes, the underlying logic doesn't. Fine. Everyone covering this niche has said some version of that by now. And honestly, they're right to it. The correct starting point. Here's what almost nobody says next. So you still want one. Because the company that perfected this model isn't really in the gym business anymore. It's in a business you'd recognize instantly if you worked in finance, and wouldn't recognize at all if you just went there to work out. Planet Fitness, the $10 a month chain, ended 2025 with just under 2,900 locations across the country. Roughly 90% of them, over 2,600 clubs, aren't owned by the company at all. They're owned by independent franchisees, ordinary business owners who signed a franchise agreement, put up their own capital, and carry the local risk of rent, payroll, and equipment. Planet Fitness, the public company, mostly just collects from a comfortable distance on every single one of them, and collects well. A 7% royalty on every dollar of membership dues that comes through the door at every franchise location in the country. Every single month, a 2% contribution into a national advertising fund, a $20,000 fee just to open a new location plus fees on the equipment installed inside it. Add it up, and Planet Fitness runs an adjusted EBITDA margin of roughly 41%. Sit with that number for a second: 41 cents of pure operating profit on every dollar for a company whose product costs members $10 a month. That's a margin most software companies would be thrilled with. It is not a normal margin for a business built around treadmills and paper towels. So you still want one. Here's where it stops looking like a gym company at all and starts looking like a bank. Since 2018, Planet Fitness has gone to the bond market 5 separate times using something called whole business securitization. Here's what that actually means in plain terms. The company bundles up its future franchise royalty payments, the 7%, the 2%, all of it, and sells that future income stream to investors as bonds structured almost exactly like a mortgage-backed security. Except instead of homeowners' mortgage payments, the underlying cash flow is thousands of individual gym members, monthly dues filtered through the franchise fee stack before it ever reaches a bondholder's account. Across those 5 deals, Planet Fitness has raised more than $4.3 billion this way, using the proceeds to refinance older debt and in more than one instance to fund dividends and stock buybacks for its own shareholders. Its current total debt sits around $2.2 billion, rated BBB by both S&P and Kroll Squarely investment grade, the same rating tier as plenty of ordinary corporate bonds from household name companies. And these aren't loose, informal arrangements. They come with real Wall Street mechanics built directly into the paperwork. If the royalty cash flow ever dips below a set coverage ratio, the deal triggers what's called a cash trap, seizing the excess money before it can reach shareholders and holding it in reserve for bondholders instead. Dip further still, and it triggers rapid amortization, legally forcing the company to pay bondholders back faster than originally planned, regardless of what that does to the company's own cash position. Bondholders who have never set foot in a Planet Fitness, who may never have even heard of the brand, have a real, contractual, legally enforceable claim on how healthy that royalty stream needs to stay quarter after quarter. So you still want one. Here's the plain version of what that means. For anyone who's ever actually paid one of these memberships when you join a Planet Fitness, some portion of that $10 or $15 is not primarily paying for a treadmill or the electricity bill or the guy at the front desk. It's flowing through a corporate structure, engineered by the same kind of investment bankers who build mortgage bonds, ultimately servicing a $2.2 billion pile of debt. Most members have never heard of and never will. And it's not just Planet Fitness anymore. Self-Esteem Brands, the parent company behind Anytime Fitness, The Bar Method, and now Orange Theory Fitness, ran its own version of this same securitization structure starting in 2021. What started as one company's clever financing trick is becoming the standard playbook for how the biggest fitness brands actually fund themselves. The gym is the storefront. The royalty stream is the actual product being sold to investors who will never lift a weight in their lives. So, you still want one? Here's a threat that was supposed to end this entire industry and appears to be doing almost the opposite. When GLP-1 weight loss drugs Ozempic, Wegovy, Mounjaro went from a diabetes treatment to a cultural phenomenon in the space of just a couple of years, the obvious assumption was simple, and it was everywhere. In industry newsletters, on finance podcasts, in gym owner group chats, if a weekly injection does the weight loss for you, why would anyone still pay for a gym membership at all? Some analysts openly wondered whether this would be the beginning of a slow, permanent decline for the entire fitness industry. As of the most recent data, roughly 12% of American adults are now taking one of these drugs, and the national obesity rate has fallen from close to 40% in 2022 down to 37% in 2025. In what is genuinely one of the fastest population-level health shifts in modern history, on paper, that should be a gym industry's nightmare scenario, arriving faster than almost anyone in the industry expected to have to plan for it. Here's the mechanism nobody predicted correctly, and it's the whole reason this story flips upside down. GLP-1 drugs don't just burn fat. They also cause meaningful muscle loss as a documented side effect alongside the weight loss everyone was focused on, which means a huge and rapidly growing population of people are losing weight fast and simultaneously need somewhere to specifically fight to hold onto the muscle they're losing along the way, often for the first time in their lives, having any reason to walk into a weight room at all. Roughly 42% of people on these medications report that they've actually increased their physical activity since starting the drug, not decreased it. One industry analysis projects GLP-1 adoption could grow the entire gym and fitness studio market by 20% worth an estimated $6.8 billion. So you still want one. Here's how fast the biggest brands in the industry have already moved to capture this, which tells you how real they think it is. Lifetime, the upscale athletic club chain, has acquired weight loss clinics staffed with doctors who can prescribe GLP-1 medications directly bundled into a program it calls Miura, effectively turning the gym membership desk into a front door for a medical service it never used to offer. Equinox launched something it calls a GLP-1 protocol, a training program built specifically around helping members preserve muscle while they're on the medication, marketed directly at existing members who mentioned they're taking it. Weight Watchers, a company that spent decades building its entire identity around point counting and portion control, pivoted its whole membership model toward medical access to these same prescriptions, a genuine reinvention of a 50-year-old weight loss brand in real time, in response to a drug that could have destroyed it instead. Even the budget end of the market stands to benefit arguably more than anyone, as GLP-1 prices keep falling and more of the population can afford them. Low-cost chains like Planet Fitness are positioned to pick up exactly the customers these drugs are creating. People who've lost the weight need somewhere cheap and unintimidating to rebuild the muscle, and we're never going to pay $200 a month at a boutique studio anyway. The drug that was supposed to be the fitness industry's biggest competitor turned into one of its best unpaid sales reps. So you still want one. Here's the other side of this business, the side that doesn't show up in a crowded parking lot. Not every gym chain built on debt gets to walk away from it. And the difference between the two outcomes tells you almost everything about this business. 24-Hour Fitness spent years under private equity ownership, financed the way most leveraged buyouts are financed. Acquisition debt loaded directly onto the company's own balance sheet, so that the company itself, not the private equity firm's own capital, ends up carrying the weight of its own purchase price. It's the same basic mechanism, just at gym chain scale, that sat behind plenty of hotel collapses, retail chain bankruptcies, and office leasing disasters in businesses that look nothing like a gym on the surface. For years, membership dues kept flowing in reliably enough to service that debt, and the model looked fine, right up until it wasn't. The company filed for Chapter 11 bankruptcy in June of 2020, citing both the pandemic shutdown and the debt load it had been quietly carrying for years before anyone had heard the word lockdown. Same basic tool as Planet Fitness's bond deals, debt layered on top of a subscription business built around recurring monthly dues. One company built a debt structure that Wall Street rates investment grade, with cash traps and coverage ratios specifically designed to protect bondholders through a downturn. Another built a debt structure that simply collapsed the moment revenue wobbled for a few consecutive months. The treadmills, the members walking through the door every morning, the size of the parking lot, none of that was ever really the deciding factor. The difference was who was holding the debt, on what terms, with how much cushion built in to survive a genuinely bad year. Let's say your own gym gets everything right. You've built or bought into a location where the neighborhood income and your pricing genuinely match. Your churn sits on the low end of normal instead of the high end. You've layered in the two revenue streams that actually move the needle beyond bare membership dues. A real personal training program, and increasingly, a genuine plan for the growing wave of members arriving because of GLP-1 drugs rather than despite them. Your fixed costs are covered comfortably by your paying base, which means every additional member past that point is close to pure profit. That's a genuinely durable small business. Predictable, recurring, resilient enough to survive a slow month without panic. Here's the version that happens more often. Instead, churn runs at the higher end of what's normal for this industry. A cheaper competitor opens down the street and pulls your price-sensitive members away first. The same members who were the most profitable ones, precisely because they rarely showed up. Equipment repairs land above what you budgeted. the way they usually do. You didn't build any real answer to the GLP-1 shift, so a competitor down the road captures those new members instead of you. None of that is a single dramatic failure. It's 4 or 5 ordinary pressures arriving in the same year, each one shaving a little more off a margin. That was never as large as the crowded parking lot made it look. You didn't do anything wrong, exactly. You just discovered that in this business, the treadmills were never the risk. The debt structure sitting underneath them was. Here's the truth. This entire industry is quietly built on. The workouts were never the business. The royalty stack was. The bond structure sitting behind the brand name was. The debt service coverage ratio that decides whether a bondholder in a city you'll never visit gets paid before you do was. A gym isn't a building full of equipment, it's a recurring stream of small monthly payments engineered in the biggest and best run version of this business to look and behave exactly like a bond sold to people who will never once walk through the door.